Okay, so we are learning chapter 17. 17 is about cash flow statement. Cash flow statement. So the first one, we're going to talk about the usefulness, the content, and the format of the cash flow statement. Okay. So why the cash flow statement is useful? Okay, so I can give you one example of cash flow statement. Okay, so no, this one. So this one you have seen is a statement of cash flow. Okay. So then you can see that. Okay. So this one has 3 sections. On the top section is called operating activities. Operating activities. In the middle section, it's called investing activities. And then after investing activities, that is the financing activities. Okay. So under each activity, they are calculating the cash. Okay. How much cash received and how much cash used for each activity. And then they will figure it out totally, like by combining the cash together from the 3 activity, why my cash balance increased or decreased? Okay, so you may have an increase in cash or decrease in cash. Okay, and then at the beginning of the year, you have a cash balance, right? At the beginning of the year, you have a cash balance, and you have figured out what's the change in the cash, right? What's the change in the cash? So then you use the January 1st cash balance, 33,000. And then on that year, you have a net cash increase, 22,000. So now your ending balance of the cash should be 55,000. So this is your example for the cash flow statement. And if you are required to prepare a cash flow statement, you have to follow this format, right? You have to start with the operating activities and then working down to investing activity, to financing activity, and then combining all the cashes used or received together. That is your net increase or decrease in cash. So why this cash flow statement is useful? Why is that useful? It gives information about cash receipts and the payment. How did you generate cash? Where did you spend the cash, right? This will help the investors, creditors, and others understand the company's ability to generate future cash flow, right? So your current performance is often a good indicator or predictor of your future performance, right? Sometimes it's interesting when you observe a toddler, right? You observe the toddler's behavior, right? You may be able to start predicting what kind of man this boy is growing up into, right? So your current performance, your current behavior is a very good predictor for the future behavior, for the future performance. It will help the investor, creditor, and others understand the company ability to pay dividends and meet obligations. Right? I want to see how much cash is generated, and how that cash is used. Is there enough cash to pay the bank interest, to pay the loan? Is there an actual cash after paying the debt can be used as a dividend, distributing them to the investor, right? Investing and the financing transaction during the period. So what is the investing? Investing is about non-current asset, okay? Non-current asset. So you buy a land, you buy a building, you buy investment bond, holding them for maturity. So those would be your non-current asset, okay? And that will be dealt with not in the operating activity, it's in the investing activity. Financing activity deals with non-current liability and equity. Financing transactions often is a process requiring money. Either you deal with the shareholder, right? You can raise capital by issuing stocks to them. Okay, so in that case, you can receive some more cash from the investor. You could also, let's say, deal with your debtor, right? Pay off your debt. So that would be your financial transactions, right? It deals with non-current liability and deals with equity. A cash flow statement is prepared using cash and cash equivalents. So you may wonder, what is the cash equivalence? What is the cash equivalence? So the cash equivalents are highly liquid investment, readily convertible to cash. Highly liquid investment, readily convertible to cash. So for example, you may purchase, let's say, a 60 days treasury bill, right? So the treasury bill promises you interest for, let's say, 60 days, 2 months, right? If you may wonder why we do that, right? But if you have a large amount of money, right? The interest rate is still even a little bit more interest rate promised by treasury bill, it makes a big difference compared to put them into the saving account, right? So treasury bill, let's say 60 days treasury bill, you are able to convert that treasury bill into cash after 60 days. So the time period is relatively shorter, right? So therefore, when the items are highly liquid, they are readily convertible to cash, okay? So those will be considered as cash equivalents. Okay, so operating activities, it is the transaction effect in terms of creating revenue, incurring expenses, and it's also related to the non-cash current asset and the current liability. Investing activities is going to affect the non-current assets. This includes the buying and selling long-lived asset, buying and selling long-lived asset or equity investment, lending money and collecting loans. Financing activity affect the non-current liability and the shareholders' equity account. Okay, so you could, like I mentioned, issue a new debt. Okay, or you can use, if you have extra cash, you can pay off the debt. Okay, you can also issue stock dividends, getting the cash from the shareholders. If you don't need that extra cash, you can also give the cash back to the shareholders in the form of dividend. Okay. So this picture explains everything really well. Take a look at this picture. So for operating activities, income statement is relevant, and the balance sheet is relevant only to the extent of current asset and the current liability. Investing activity, only balance sheet is relevant. That's for the long-lived asset. Financing activity, again, only the balance sheet is relevant. Okay. And it deals with the non-current liability and the shareholders' equity. So that are the three activities: operating, investing, and financing. Does any of you have a question?
No.
No? Heika, do you have a question?
No.
No? Okay. Um, not all the transactions will have impact on cash, right? Some transactions does not have any impact in cash. So when we say about impact on cash, we were saying either cash will increase or cash decrease, right, as a result of the transaction. But there is a third scenario: the cash balance doesn't change, right? You have a transaction, but the cash position doesn't change. So why? Let's take a look. So I want you to tell me what is the journal entry for. I want you to tell me what is the journal entry for issue a debt to purchase asset. Tell me what debit, what credit, debit what account, credit what account. You issue a debit to purchase asset. Tell me this accounting journal entry, what do I debit, what do I credit, and to what account? So issue of debt to purchase assets. What is the accounting journal entry?
Do you debit assets?
Yeah, debit asset. Yeah. And credit.
Cash?
Sorry, credit what?
Is it cash?
Issue debt. So when you issue debt, you owe people money, right?
No, I said cash.
Yeah, cash. Okay. So did anyone pay cash? They were saying issue debt to purchase. So I want to purchase asset, right? But I have to give you a debt, like an issue, like a debt instrument, maybe payable, right? So my asset increased. What else increased? So you haven't paid them yet, right? So you credit debt, right? You credit debt. This is liability, right? It's just like when you buy things, you don't have the cash, the money to pay. You said, well, I will pay you later, right? So that's the debt. So in this transaction, there's no cash, right? Only an asset account and the liability account will be impacted, but not the cash account. Now, what about this one? Conversions of debt or preferred shares into common shares. Conversion of debt to common shares. What is that journal entry? So that would be your conversion, the debt or preferred shares to common shares. Your common shares will increase, right? So you credit your common shares, but you conversion of debt, right? You have debt before, but now you change the debt into common shares. So your debt decreased. You debit your debt. Again, there's no cash involved, right? There's no debit cash or credit cash. This is just other account in the journal entry are the other account, the accounts other than the cash, right? So not all the transactions will cause an impact onto the cash flow statement if this transactions does not involve cash. Does that make sense? Okay, so when you prepare the cash flow statement, you can use two methods, either an indirect method or a direct method. Okay, so either an indirect method or a direct method. So normally, in the real life, people, most companies will prefer to use indirect method. Okay, and for the purpose of this course, I will just focus on the indirect method. The direct method will be left to the future accounting courses. Right now, we are only talking about indirect method. So your goal is to produce a statement looks like this. Okay. So for the formatting purpose, right? Your goal is to produce that statement of cash flow following this example, right? So on the top, cash flows from operating activity, and then cash flow from investing activity, and then cash flow from financing activity. And then you combine them together, you figure out whether the cash has increased or decreased. And then based on the beginning cash balance, you are able to figure out the ending cash balance. Does this make sense?
Yes.
Yeah, okay. Good. Okay, let's take a 10 minutes break.